Three things just happened in the last 48 hours. A major U.S. bullion bank quietly expanded its silver derivatives footprint. Registered inventories inside the primary U.S. futures exchange tightened again, and call option positioning surged into the next delivery month. Individually, none of these make headlines. Together, they change the structure of the silver market. And almost nobody in mainstream financial media is connecting the dots. While television panels debate rate cuts and CPI decimals, something far more structural is unfolding beneath the surface in warehouse receipts, delivery notices, and derivatives exposure. Silver is not moving randomly. It is being positioned. Over the past two sessions, order flow in the futures market has shown a clear pattern. Aggressive upside call, buying paired with concentrated short positioning at specific strike levels. That tells you this isn't retail speculation. This is structured capital. At the same time, inventory classifications inside the primary delivery exchange have shifted. Eligible metal remains, but registered, the metal actually available for delivery, continues to compress relative to open interest. That ratio matters, because silver is not priced in coin shops, that it's priced in leverage. And leverage works until it doesn't. Now, add one more layer. Large bullion banks have historically acted as liquidity providers. But when positioning becomes one-sided, liquidity providers can become liquidity takers. And when a single institution increases control over both derivatives exposure and physical warehouse flows, it doesn't mean manipulation. It means influence. Influence over volatility, influence over timing, influence over who gets metal and who gets cash settlement. By the end of this video, you're going to understand why this is not just about price direction. It's about market structure. You'll see how policy decisions, minor margins, physical premiums, and options gamma are converging into one unified macro setup. You'll understand the difference between theoretical squeeze narratives and mathematically probable stress points. And more importantly, you'll see why the next 6 to 12 months in silver will not look like the last 5 years. Because when concentration rises in a thin market with industrial demand growing and inventories tightening, the outcome is not chaos. It's repricing. Let me show you why. Policy/government action. Start with the macro backdrop. The Federal Reserve remains in restrictive territory. Real rates, while off their peak, are still positive. Liquidity is not abundant. Treasury issuance remains elevated. The U.S. government is financing persistent deficits at higher interest costs. That matters for metals. When fiscal expansion meets tight monetary conditions, two forces collide: currency strength in the short term and structural debt pressure in the medium term. Historically, silver responds not to headlines, but to liquidity inflections. Now, consider recent Treasury issuance cycles. Heavy bill issuance absorbs short-term liquidity. When that liquidity tightens, leveraged funds reduce exposure. That often pressures metals temporarily. But here's the pivot. As rate expectations begin shifting toward eventual easing, even slowly forward curves adjust first. Options markets adjust second. Physical flows adjust last. We are now in phase 2. You're seeing rate volatility compress. You're seeing longer duration Treasury yield stabilize. And you're seeing capital quietly re-enter hard assets, not aggressively, but strategically. Policy translation into real-world terms. Governments need inflation higher than financing costs long-term. Debt sustainability improves when nominal growth exceeds interest expense. Metals act as long-duration insurance against policy miscalculation. Silver, unlike gold, carries industrial sensitivity. Solar demand, electronics, electrification, these are not cyclical fads. They are structural consumption channels. So when policy remains restrictive but fiscal spending stays elevated, silver sits at a macro crossroads. Too tight it stalls, too loose it accelerates. Right now, positioning suggests large players are preparing for acceleration. Corporate earnings/minor signal. Now move to the miners. Recent quarterly earnings from major primary silver producers show something interesting. Realized prices have improved, but margins haven't expanded proportionally. Why? Two possibilities. First explanation: cost inflation, Energy, labor, permitting, environmental compliance, all rising. Second explanation. Hedging structures limiting upside capture. Some producers lock in forward sales to stabilize cash flow. If prices spike after those contracts are set, miners don't fully benefit. Which is more likely? A combination, but cost pressure is dominant. All-in sustaining costs for many producers remain elevated. That means current silver prices are profitable but not explosive. Here's why that matters. When prices rise and margins don't expand aggressively, it discourages rapid production growth. No surge in new supply. No flood of new ounces. Meanwhile, industrial consumption continues trending upward. That creates a subtle supply-constrained environment. Miners are not signaling oversupply. They're signaling discipline. And disciplined supply in a leverage-driven futures market creates asymmetry. Physical market evidence. Now step into the real world. Retail dealer premiums remain above historical averages. Not extreme, but firm. Shipping times for certain minted products fluctuate during price volatility spikes. Industrial buyers continue locking long-term contracts rather than relying solely on spot purchases. In Asia, pricing occasionally diverges slightly from Western benchmarks during high-demand windows. None of these individually scream shortage, but they do indicate tightness. The key metric isn't whether metal exists. It's whether it's readily deliverable without price adjustment. Physical silver markets don't operate like digital assets. They require transport, insurance, financing, and fabrication capacity. When volatility increases, logistical bottlenecks amplify pricing moves. And that's where futures structure becomes critical. Derivatives/futures/options pressure. Here's the core. Open interest in silver futures consistently exceeds registered inventory by a significant multiple. That's normal. Futures markets are designed for hedging and speculation, not full physical delivery. But stress appears when a larger than usual percentage stands for delivery. Call options near key strike prices create gamma pressure. If price rises toward those strikes, dealers who sold calls hedge by buying futures. That buying pushes price higher, which forces more hedging. That's not conspiracy. That's mechanics. Now combine tight registered inventory, concentrated call positioning, industrial demand baseline, controlled miner supply. You get a structurally sensitive market. Delivery math matters. If even a modest increase in longs choose physical settlement, warehouse stocks must reclassify eligible metal or incentivize cash settlement. Probable scenario? Volatility spike. Not default. Not collapse. But repricing through speed. Connecting all threads. Now step back. Policy remains restrictive but nearing inflection. Miners are disciplined, not expanding aggressively. Physical markets show steady demand with mild tightness. Derivatives positioning is building asymmetrically, and institutional concentration appears elevated. This is not random noise. This is compression. Markets compress before they expand. Silver historically underperforms gold until it doesn't. When it moves faster. The thesis is not panic squeeze. The thesis is structural repricing probability rising over the next 6 to 24 months. Large institutions positioning early doesn't mean guaranteed upside. It means asymmetry is being evaluated seriously. And when asymmetry attracts capital, volatility follows. Let's step back and compress everything into its clearest form. 4 signals. Not headlines. Not hype. Signals. First, policy is restrictive, but forward expectations are shifting. Real rates remain positive, yet the bond market is no longer pricing perpetual tightening. Liquidity conditions are tight, but the trajectory is softening. Historically, metals do not respond to the peak of restriction. They respond to the transition away from it. Second, miners are not expanding supply aggressively. Earnings show profitability, yes, but not the kind of margin expansion that unleashes massive new production. All-in sustaining costs remain elevated. Capital discipline remains intact. That means supply growth is constrained at the very moment structural industrial demand continues to trend higher. Third, the physical market is firm. Not in panic, not in shortage, but tight enough that premiums hold, industrial contracts extend, and deliverable inventories matter. This is not a collapse in demand. It is steady absorption. Fourth and most critical derivatives positioning is building in a way that magnifies sensitivity. Open interest remains large relative to registered inventory. Call option positioning near key strikes creates potential gamma acceleration. Concentration among major liquidity providers increases structural influence. Now combine them. Policy inflection potential. Disciplined supply. Firm physical demand. Leverage layered on top. That is not chaos. That is compression. And compression precedes expansion. What does this mean for the next 6 to 24 months? It means volatility probability is rising. Not guaranteed upside. Not inevitable breakout tomorrow morning. But rising probability that when a catalyst appears, whether it's a liquidity shift, a policy surprise, or a delivery imbalance, the move will not be linear. Silver historically trades quietly until it doesn't. It spends long periods frustrating both bulls and bears, grinding, consolidating, failing to break resistance. But when structural pressure builds beneath the surface, repricing happens quickly. The key distinction is this. Is the system fragile? Or is it merely leveraged? Right now, it appears leveraged, not broken. There is no confirmed systemic failure. No exchange default. No vanishing metal. The futures market is functioning as designed. But functioning markets can still experience rapid repricing when leverage meets constraint. Consider the mechanics. If even a modest percentage of futures participants increase delivery intent during a high open interest cycle, warehouse stocks must adjust. Eligible metal may reclassify. Cash settlement incentives may rise. Spreads may widen. None of that equals collapse. But all of it equals volatility. And volatility in a thin market like silver compounds quickly. Now let's address the alternative outcomes, because serious analysis requires balance. What if industrial demand softens? A global slowdown would pressure electronics, solar installation pace, and manufacturing output. That could reduce physical offtake and relieve tightness. What if real rates remain elevated longer than expected? Persistent monetary tightness would strengthen the dollar and suppress speculative enthusiasm in metals. What if call positioning unwinds before expiration? Dealer hedging pressure would fade, removing one potential accelerant. These are valid scenarios. Markets are not one-directional machines. But here's the structural counterpoint. Debt levels globally remain historically high. Governments cannot sustain permanently restrictive real rates without economic consequence. Fiscal expansion continues. Energy transition initiatives remain active. Electrification trends are secular, not cyclical. Silver sits at the intersection of monetary hedge and industrial input. That dual identity creates asymmetry. When monetary conditions tighten, industrial demand cushions. When liquidity expands, monetary demand amplifies. It is one of the few assets exposed to both forces simultaneously. That dual exposure is why structural compression matters. Now zoom out even further. Over the last decade, silver has underperformed gold in relative terms. The gold-to-silver ratio has remained historically elevated. That divergence reflects investor preference for monetary stability over industrial volatility. But ratios do not stay extreme indefinitely. When capital rotation begins, silver historically accelerates faster than gold because of its thinner market depth and higher volatility coefficient. That is not prediction. That is historical pattern. Yet history does not guarantee repetition. What matters is whether conditions rhyme. Right now, concentration is rising. Inventory sensitivity is rising. Leverage remains elevated. And macro policy stands at a potential turning point over the coming year. That is not a trivial alignment. It does not require panic. It requires awareness. Too many investors approach metals emotionally either as doomsday insurance or speculative lottery tickets. That framing misses the structural reality. Metals are balance sheet assets. They respond to liquidity, regimes. They respond to fiscal credibility. They respond to real rate trajectories. And they respond to market structure mechanics. This is about structure. If structure tightens while leverage expands, volatility increases. If liquidity loosens while supply remains disciplined, repricing accelerates. If both happen simultaneously, regime shifts occur. The question you should be asking is not, will silver explode next week? The question is the risk-reward skew changing? Because capital allocation is about probabilities, not certainties. Over the next 6 to 24 months, several milestones will matter. Rate cut, timing clarity. Treasury issuance absorption. Registered inventory trends. Open interest expansion or contraction. Industrial demand data from major consuming nations. Watch those. Ignore the noise. If inventories stabilize and leverage declines, the market resets calmly. If inventories tighten while leverage grows, sensitivity increases. That's the equation. No drama required. Now, let's speak plainly. Large institutions do not position heavily without modeling stress scenarios. They do not expand exposure randomly. When concentration builds, it is usually because asymmetry appears attractive relative to alternatives. That does not mean they are infallible. It means they see probability edges. And when probability edges align across policy, supply, and derivative structure, capital responds. Silver is not screaming. It is coiling. The difference matters. A scream attracts headlines. A coil builds silently. The mainstream conversation remains focused on CPI prints, quarterly earnings cycles, and equity rotations. Very few are watching warehouse ratios. Very few are analyzing strike concentration. Very few are modeling delivery math relative to registered stocks. But those mechanics determine velocity when price moves. In leveraged markets, velocity defines opportunity. So where does that leave us? In a period of elevated optionality. Optionality means outcomes are skewed, not certain. The downside risk remains contained by industrial utility and production costs. The upside risk is amplified by leverage and thin liquidity. That asymmetry is why structure matters more than sentiment. And here is the final grounding principle. Markets transition quietly. There is rarely a siren announcing structural shifts. There is positioning. There is inventory flow. There is subtle concentration. There is compression. Then there is repricing. You do not need to believe in manipulation to recognize influence. You do not need to predict catastrophe to acknowledge sensitivity. You only need to observe the alignment of forces. Policy nearing inflection. Supply disciplined. Demand steady. Leverage layered. That is the setup. It may take months to resolve. It may take a catalyst. But the ingredients are present. So remain analytical. Track the data. Separate theory from probability. And most importantly, understand structure before reacting to price. Because when structure shifts, price does not ask for permission. It adjusts. And those who studied the mechanics beforehand are not surprised by the move. They are prepared for it. The silver market is not broken, but it is increasingly sensitive. And sensitivity in finance is where opportunity and risk are born. Watch the ratios. Watch the positioning. Watch the policy inflection. The next phase will not be random. It will be structural. And structure always wins in the end.